Hey, this is Dak Hartsock, ACI Advisors, with the April 2019 Bull and Bear Report, which is the market risk update for those of you that are not familiar with this. Let's hop right into it. I'm Dak Hartsock, Chief Market Strategist at ACI. What we're covering here today is really the section that's bolded here. I'm not going to review any of this stuff. We're just going to get right into the report. But this is part of the independent research that the firm does that's designed to do things that most other advisors either don't do or don't bother with. And you'll see more about that as we get into it. If you want to learn more about the firm or I, you can just visit aciwealth.com, click on About, and you'll get our full story. And I apologize, I have a bit of a cold, so I may be sniffling or snuffling a little bit as we go through this. Now, very quickly, ACI uses a 13-point risk management model with our partner accounts. And the way it works is we look at both technical, fundamental, and macro factors. And as you'll see as we get through this model, it's been very, very accurate in the past. There's no guarantees that the future is going to play out just like the past has, but as you're about to see, it really indicates when we've got a stable and positive investment climate where investors can expect good positive returns over time versus places where risk gets a little bit higher. So the first part of our model is the tactical, and this is the least important of the risk management that we use. But even if you were just to use this model, this component of our model, you would still basically double the performance of the S&P. And what we use this section of the model for is basically the canary in the coal mine, right? It's kind of our early warning. And the way it works is this. What you're looking at is approximately 20 years of the S&P, going back to about a little before 2000. And the green lines are during an up phase, right? So the 16.5% is prior to the warning, and then we get a downdraft here, and then the green comes in again, and we get a nice updraft. And what you see is it's pretty accurate. It's not always accurate because sometimes you can get a warning and not much happens. You know, we saw that around 2015, you know, depending on how you calculate this, end of the month, beginning of the month, whatever. This section could arguably been a couple percentage higher. The way I calculate it, it was a small loss. So let's kind of review what's going on here. What we're looking at is price behavior, first off, right? So that's if the price is going up or down. And for those that don't know, these are these little sticks here. They're called candlesticks. And then we're looking for what's called relative strength. And then we're looking for what's called moving average, divergence, or convergence, right? So what we look at is when we see these moving averages move down, right? So this 50, or this is the blue line is the 50 week, the yellow line is the 200 week, and these bars are price. So what we see is that when the price falls below this line and the 50-day falls below the 200 line, that is the first alert in the tactical model. Then we're also looking to see if we're coming off an overbought situation in terms of relative strength. That's pretty important, right? Because if we see this happen and we don't have an overbought situation, generally that doesn't result in negative outcomes. So that's the second component of what we're looking for. And the third is down here at the bottom where you see the blue line go beneath the yellow line. And that's called a divergence, right? So when the blue line goes below the yellow line, generally it's a pretty solid warning that the market's about to get volatile, unpredictable, and potentially sell off quite a bit. So if you had to just follow this portion of our risk management model, and what that means is you had a risk down when we hit these red lines and then risk back up when we hit these green lines, you basically would have doubled the S&P's performance. So it's nice to have as a canary in the coal mine. And what we saw back in the fall is we began to get that canary in the coal mine warning. But when we looked at the fundamental factors underlying the market and the macro factors underlying the market, the decision was that we were really looking at something that was probably going to be very short term, and that at some point, sometime in the late spring, early summer of this year, the markets would recover, and that's what we're seeing so far. So, and you can see we have the red warning here, and then the market went down about 17%. And then since it's come back to the same level where it fell, we're up about 4.4 and very close to all-time highs. So nice to have this warning. Again, you can't read too much into it, but it is kind of the early warning system that tells us we need to pay more attention to macro factors or to fundamental factors in case there's a problem there as well. So let's talk about fundamental factors. Serious markets occur during recessions. And we use a tool called the Recession Probability Indicator that looks at 6 very precise data sets provided by the Fed. They're public information. You can go to the Fed and find them for yourself. And what we did is we looked at hundreds of data sets and hundreds of hours doing this to find the ones that correlated exactly with recession. And what we find is that we can put these data sets together and we assign a simple algorithm to them. And when that algorithm gives us a score over 20, we have a rising recession risk, right? In other words, the percentage probability that the U.S. is going to be in recession at that moment gets quite a bit higher. Now, I want to make sure this is understood. We are not predicting recession. No one in the history of mankind has ever been able to consistently predict the future. We don't think we're going to be the first, so we're not even bothering with that. So we don't predict when the U.S. is going into recession. We're going to let the media do that kind of stuff because they don't mind it when they're wrong and no one remembers. But what we are very good at is being able to tell when the U.S. is in recession. And when that happens, typically the market reacts about 6 to 9 months after the U.S. is actually in recession. So this gives us some time to make some risk adjustments in portfolios on a historical basis. And what we can see right now is the economy is just kind of doing what it normally does. It moves on this algorithm somewhere between, about 2 and 20. And usually it's between 10 and 15, 10 and 17, and that's where we are right now. We're at a 17 reading. That tells us that the investment climate is stable and the high probability is that continued investment will be rewarded. And that's what we're seeing right now. Now, this is based on Delito's work. I don't agree, as I've said before, on everything that he does and says, but I think he's got this exactly right, this table. I can't remember what he calls it, but it's very, very useful when you're understanding the things that truly drive bull and bear markets, and that's earnings, inflation, interest rates, and price behavior. And what we've got here is a table that looks at different scenarios, right? And right now, as we were in the fall, it appears we're in an end phase of the bull market where earnings are rising, inflation is rising, interest rates were rising, prices are rising. So, but it's important to differentiate, right? Just because we're in a phase where a bull market could potentially end does not mean you should risk down, because bull markets, even in this end phase, can endure for years and years and years. And you can find yourself and your family missing out on a lot of the great benefits that a bull market can confer on investors. Now, there's a wrinkle to this that's happening right now, right? We have earnings up, inflation is very weak, interest rate raises have been stopped, at least temporarily, and prices are continuing to rise. So if we look back and we see a situation where earnings are rising and inflation is falling or interest rates are falling and prices are up, that's where a bull market thrives. So what's going to happen is if inflation falls and earnings begin to weaken a little bit into next year, then my guess is that the Fed is going to cut rates a little bit. So then we'll have the situation where we're back into a climate where the bull market thrives. Right now, we're kind of in no man's land between bull market ends and bull market thrives because interest rates are no longer rising. So we'll see where that goes. But the point of this is that all the factors that drive continued bull markets are currently in play. Despite what the media says, despite their fear-mongering about interest rates, despite their fear-mongering about U.S. and recession, and we've seen these things are not true, right? Over the last several months, everybody that was a doomsayer got a chance to be on CNBC or CNN, and none of it's come true, right? And that happened in 2015, and it's probably going to happen again before things actually get to a point where you need to risk manage down. And the reason for that is because the fundamentals underlying the bull market are currently very solid, and the fundamentals underlying the economy, although they're not spectacular, we are in an expanding economy. We're clearly not in recession. And so these are things that, taken together, really help bull markets go. And now I want to add a little more commentary on interest rates. Because the phrase here is that bull markets don't end of old age. They are murdered by the Fed. And as we can see historically, that's true. And the way the Fed murders bull markets is when they raise rates too aggressively or too mechanically. And when that happens, they stifle growth, earnings begin to fall, interest rates go up, right, because they're raising rates, and stock prices begin to fall, and everything kind of goes sideways. And if we look historically, what we see is that when the Fed does raise the real interest rate, so that's the interest rate, the Fed rate minus inflation, when it gets above 1.6 at the lowest, that's when recessions can start. But we've never had a recession, and I couldn't fit more data on this, but we've never had a recession where the Fed funds rate, the real Fed funds rate, was below 1.6%. And when you're below the center line here, then that's considered stimulative to the economy, meaning it's helping the economy grow. Well, for the first time in a decade, real interest rates have gone just above 0%. They're actually at 0.03% right now. So that is still really neutral and arguably a little bit stimulative to the economy, which means that all the factors in place for a continued expansion are in play. So we're still kind of in a Goldilocks place, particularly as we've got a Fed that seems to be responsive to the markets and is willing to make adjustments on the fly as needed by the data. Now, the proof in the pudding here is this line below is the Wilshire 5000. That's 5,000 companies, better model than just taking 500, the S&P, which is kind of arbitrary. This is a better slice of the American markets and what happens to them when the economy is positive. And as you can see, is every time rates get too high, it has an impact on the market, right, in the recession. So it falls slightly or it levels out. But it's also the same thing when we see rates falling or rates fairly neutral. You see the market has the ability to move up. That's where we're at right now. So there's a lot of fear continuing in the markets, but it's not reflected in reality, and I hope that's clear from this. Now, if that's what you wanted to hear and you're not interested in what I think is going to occur next, you can shut it off now, and thanks very much for the time. Real quick, I'm going to jump into the previous risk update and kind of give an update on what I thought was going to happen. So in spring of last year, my hypothesis was that the market was correcting and it was stuck in here, and my view was that it was going to move up out of that and up all the way into new highs, and that turns out that that's what happened. And then in October, my view was that we were going to have a fairly deep correction, and that it was either going to stop here at the previous intermediate uptrend, or that it would establish a new intermediate uptrend somewhere in this range after the correction was over. And what we saw is, and I figured it was pretty close between either one of those, it could go either way. So what we saw is that the market fell all the way down to fair value, which is this blue line, but in the fall, fair value was down here around 25.55. And it fell past that. A lot of people got alarmed, but of course it bounced right back up because of all the reasons I just discussed. So now what I think is going to happen is we've had a pretty serious run. I think it's going to bump into the prior intermediate uptrend, and then it's going to come back down to maybe this 28.80 level, may fall all the way down to this kind of 27.75 level, 27.50 level, and then I think we'll bounce around in there, and then assuming the risk model stays intact, we'll probably move on to new highs from there. So that's my view of things. I went a little longer than I expected to. I appreciate your time. As always, if you have any questions or you'd like to discuss this a little bit more, just get in touch. Partners have all my contact information, office phone, email, and cell phone. If someone forwarded this to you and you have questions, just feel free to stop by the site and submit a question or email directly if they pass on my contact information. Thanks very much, and hope everyone's enjoying the weekend. Sorry I went so long.